Okay, so this is chapter 9, and I wanted to go over some of these as well. So let's talk about what items go on a balance sheet. So taxes payable typically due within a year. So we're going to say that that's a current liability. Accounts receivable, current asset. Note payable due in 90 days. Even though it's a note, it's still due in 90 days, so it's a current liability. Investment in a bond, 9 times out of 10, that's going to be a long-term investment. Capital stock is stockholders' equity. Accounts payable typically due within a year, so that's going to be current liability. So estimated warranty payable. Well, I had to look up here, and this is as of 2017. So if it's payable in 2018, that's going to be current. Retained earnings is stockholders' equity. Trademark is an intangible, and then mortgage payable. Well, this $10,000 that's due this year is current. Everything after that is long term. So those are our balance sheet items. So if we're looking at promissory notes, the big thing about this is going to be we're going to have to figure out how much we're going to owe at the end of the year, because that is going to be interest payable. And we are going to have to put that on our balance sheet at the end of the year. So we're going to have to figure out how much we've incurred. So if we take out a loan July 1st and our year ends December 31st, we are going to have July, August, September, October, November, and December worth of interest. The way to figure this out is not to use this 10-month. Every interest payment, every interest rate that we see is always going to be on an annual basis. So this 8% is an 8% annual basis. This 10-month means nothing at this point. It's just when it's due. So 8% is, in order to figure this out, and again, I think using Excel is probably the easiest way to do it. So I'm going to take, it's going to be the principal of 25,000 times your rate. So if we were doing it on an annual basis, then 8% this would be how much interest you're paying on an annual basis. Well, we're not paying it. Oops, I put one too many zeros in there. We're not paying it on an annual basis. We want to figure out how much we owe from July 1st to December 31st. So again, July, August, September, October, November, and December for 6 months. So I'm going to take that amount and divide it by 2 since it's half a year. So as of December 31st, we owe $1,000 in interest. So that's going to be the big thing about these promissory notes that we have. And then, of course, once we have to pay it, it's a 10-month note, so we've already accounted for 6 months of it. So then once we have the 6 months, then we need to figure out what's going to be for the additional 4. So I'm going to take, again, my principal of 25,000 times 0.08. What I can do now is I can figure out how much it's going to be per month. So divided by 12. So I'm going to take that amount and multiply it by 4. So that's going to give us the additional 4 months that we owe on our 10-month loan. So $1,000 in 2017 and then $667 in 2018. So we pay back the note $25,000 in 2018 when it's due, and then we owe not only the $25,000, but we owe $1,667 as well. All right, I want to talk about a discounted note for a second. So what happens with a discounted note is they just take the interest expense up front. So if you borrow $18,000 and they discount it, what happens is that you're not going to get $18,000, you're going to get whatever, 17,000 something, whatever. So you still have to treat it the same way in the respect that you have to take interest expense every month, just as if it were incurred the same way we just did it. But just keep in mind that they're taking that money up front, so you're not getting your full $18,000. All right, so with warranties, warranties are sort of similar to allowance for doubtful accounts in that you have to set aside a certain amount every year and then pull from that liability because of the matching principle again. So in this case, they indicated that 12% of all sales would be returned for repair within the warranty period. So that means that essentially you have to set aside 12% of your sales for warranty repair, which is, I guess, the $14 each time. So just like with your allowance for doubtful accounts, you're just setting aside that liability with your sales annually in order to have your matching principal in account here.